Hello and welcome to the Mutual Fund Show. We talk about what mutual funds can do over the long term for your wealth creation. At times it's also important to try and tell you how and what factors are taken into consideration when people say that invest in it for the long term. Because there are some clear, measurable factors which if put in perspective and understood well, could lead you to understand why is it that people say when you invest for the long term. Let's try and talk about one of such things, and which is the benefits that any individual investor through the mutual fund route, whichever route you choose, large cap, mid cap, small cap, debt, etc., whatever, but the demographic dividend that might and the areas around the economic growth that might actually help you understand why your wealth, if it stays invested, could actually create long-term wealth for you. Sunil Subramaniam of Sundaram Mutual Fund joins in to talk about that. Mr. Subramaniam, good having you. Thanks so much for joining in. I know a lot of people would these days say that if jobs don't come back in a hurry, then the demographic dividend could become a demographic curse. But correct. Be that as it may, yes, with the presumption that all turns out well, there are measurable factors which could make people understand why they should invest for the long term.
Absolutely, and you're right. This demographic dividend has been talked about for a long time, and if you don't create jobs, as you said, it could be a curse. But I think the interesting point at this time in phrase is that it's not just about India's demographic dividend, it's actually the destruction of the demography of a main competitor of us, which is China, which is actually aiding the process here. So what I mean here is that China was the one which took advantage of the demographic dividend over the last decade. And their per capita went from $2,000 to $10,000, and they took a huge, but curiously enough, they themselves felt the burden of the demography and hence instituted a one family, one child policy very rigidly. As a result, today, having built up all that manufacturing capacity and the ability to deliver, what's happening today is that over the next decade, China is going to lose 5 crore people from their working age group because people who are getting older and moving out, there aren't enough fresh production of people. The fact that India did not do such a family planning kind of a program means that today India is where China was in 2005-6, A, in terms of the population, B, in terms of the costs. So just to elaborate this, as I said, over a period of time, China is losing 5 crore people. So if you put that down to just a 7-year bucket, where an inter-country comparison has been done, China loses 2 crore, 21 million people up to 2027. India adds 117 million people. 6 times the amount that China is losing, India is adding to its working age population. And mind you, this production has already happened. These people are already born. So it's not something we need to sit about too. So we are sitting with a huge base, and the next biggest country is Indonesia. So with 20 million. So we have 6 times any competitor. So the point is, it's not just about the fact, it's a fact that China has demonstrated the path. They've made themselves a manufacturing capital, and today they're sitting with the fact they cannot execute that order and the size of the opportunity. That just to the US, China does $540 billion of exports. India exports 54 billion. So you're not needing a huge shift, a 10% shift of China's exports to the US to India will double our export base. So the size of the opportunity is huge, and today India is at the same per capita income that China was 10 years ago. So today an iPhone, if it's been made, and let's say an average laborer is charging you $10 an hour here, he's charging $50 an hour. So India's competitiveness, A, supply of labor, B, the cost of labor, and the third aspect to all of this is that the sheer size of this issue, right, to need to provide jobs to 116 million means that the government will be forced to act, because this is also the biggest emerging vote bank for the country. So the fact that the government will get its act over the period of the next few years, I think is a given. Whatever has happened in the past, I think if you look at it, these are inexorable forces. China can't create people overnight. And the beauty of it is we did a survey of Chinese companies, the CFOs, and said, what are you?
I think Sundaram Mutual did this.
No. One of the analysts did it. We accessed the study. And they said that China actually is looking at India as the place where they would like to shift the back end of their production, so that the front end they keep to themselves, re-export back to China, and then export to the US. So what I'm saying is the Chinese are very pragmatic. They are realizing this, and hence, so I think that's where the key opportunity for an investor comes in, because what this means is that the GDP growth of the country is essentially now based on the fact that a manufacturing base in China is gradually going to shift to India,
Okay.
and with that boost our GDP growth. And to take the argument forward in terms of what's the next step on this is that for India to then replace a portion of China
Sure.
as a supplier to the world, Indian companies can't do it because technologically and quality wise we are not there. So the route to this would be for foreign manufacturers to come and set up shop in India and use India as a manufacturing base and re-export.
Okay. So a lot of viewers, a lot of assumptions out here, and during a conversation of any such conversation, you would find some things that you do not agree with, some things that you agree with. But investing is all about building a hypothesis and then making an investment process around it. So this is the hypothesis that Mr. Sunil Subramaniam has. Your hypothesis may have some changes here and there, but with the presumption that all goes well, let's assume this is the path that we go to, Mr. Subramaniam. What does all of this have in store for an average mutual fund investor? I mean, how does he benefit? The overall size, and then are there specific themes or thematic funds? I mean, how does one approach this from a mutual fund investing perspective?
So basically, if you look at it, in the short run, the markets and the economy sometimes diverge, sometimes converge.
Right.
But if you take over a longer period, and that's why we're talking about a decade here, if you take the last 15 years, for example, right, the nominal GDP growth has been around 12-13% of the Indian economy. The large cap represented by the Nifty have shown earnings growth of 13% per annum, and the stock market, strangely enough, has delivered 14% per annum. So over a long period of time, ultimately, the earnings of companies are a function of the GDP growth, and the stock market is a slave to those earnings, and mutual funds derive and play off that to deliver the alpha. So what I've laid out here is a certain demography positive driven GDP growth path. So even if you were to take that our GDP growth, which is today at a nominal of 10%, and you give the government about 3 years to get its act in order, you need to have land reforms, labor reforms and all that. So it's not like you switch on a button from tomorrow. If you give it in 3 years, you can see that the pace of this will rapidly escalate over the decade, so that by the end of the decade, I see us at about 15% nominal GDP in the last few years of the decade, and possibly in the next decade, we could be at a double-digit real GDP growth, right? But even at this kind of a staggered growth rate, I see that for India to grow nominal GDP at 13% over the decade is not a challenge. That's what the math says. You start off with the 10, go on to 12, and then to 15, and at a 13% nominal GDP. And if you look at generally what mutual funds do is to pick the better sector. So obviously, what is the key sector here is going to be manufacturing, because that's what is going to be. Second is going to be capital goods, because you need to supply capital goods to that. Then you need to have services too. For every manufacturing job, there's 1.8 services job created. So clearly, mutual funds are able to choose sectors which are going to do better than other sectors and hence deliver an alpha. So if you look at it, mid-cap funds have delivered over the last decade about 4% per annum an alpha over the broader market. Small cap funds have delivered 3%. Large cap has been iffy because ETFs and others have come and leveled the playing field. So if you have a multi-cap portfolio, right, I think 4 at one end and flat at the other. So you take 2 on an average, which is incidentally closely what multi-cap funds have delivered, about 1.7, 1.8. So what I'm thinking is that the 13% nominal GDP growth should result in a 13% large cap earnings growth, but a multi-cap and a mutual fund combined together, there will be a little bit of alpha from multi-cap EPS and a little bit of alpha from the fund manager's selection of stocks and sectors. 15% growth per annum in your equity mutual fund portfolio, as long as you're broadly diversified across large, mid, small, across sectors, is not going to be a challenge. But the interesting point of that kind of a compounding actually makes you realize that the India we talk about our 5 trillion GDP, Mr. Modi has made that dream forward. But if this plays out, the Indian stock market could be at a 5 trillion market cap, the BSE 500 by the end of the decade. And what it means for an investor's personal wealth, that he could, if this path is churned out, it could be that you quadruple your wealth over this decade. So that's where I just wanted to tell people that the basic building blocks are already in place. It's the execution, and it's a question of timing for the execution. But you give yourself a decade long in the stock markets and give it to an expert fund manager to do the diversification and stock selection, then I'm saying that even if you take the lower end of the band and say this 10% which you're already achieving doesn't go anywhere, stays 10%, you'll still end up with a 3x multiplier. So I'm just saying that to me, even 4x is a relatively conservative number, because I've built in certain delays in the whole process. Given that we are a democracy, we can't just do all those things like China did. And the addition to this, when this manufacturing happens and the job creation happens, you have the other leg which supports the economy, which is consumption.
Right.
So while manufacturing will drive this, the consumption story has some other legs to support it, apart from just a job creation related matter.
Okay, so you are saying that people should largely invest in multi-cap funds because they will capture the best of both worlds, not necessarily get into thematic. Or are you saying that thematic funds also will actually help? Consumption, for example. I don't think there are manufacturing-based funds, but I believe on thematic funds.
I would not recommend, when you look at a 10-year period, I would not recommend thematic funds because thematics go through cyclicalities. A multi-cap fund gives you the advantage that they carry multi-themes and they carry multi-caps. So what is that? There's an expert fund manager sitting there who reallocates as he sees the winds of change. Whereas for an individual investor, sit there and say, now's the time for manufacturing, now's the time for consumption, it's a hard nut. That's why I'm saying, when I say multi-cap, is because you're effectively delegating to the fund manager, choose for the next foreseeable future that which will do better, and when you feel that has achieved its purpose, please shift it along. So that's where I think a multi-cap is a good bet. And since you mentioned consumption, I should also tell you that there are other factors in consumption which are going to give you a boost here, which is one is that per capita income, you should make an assumption that we don't hit the China numbers. Because China went from 2 to 10. Right now, that kind of a thing in India, let's say you do only half of that. Even what that means is that the mix of the population, that you take the poor, the lower middle class, the mix of and already this trend is in place. There's a rapid reduction in the poor and a rapid rise in the upper middle class and the rich. So fundamentally, from a consumption perspective, what happens is the poor people are worried about roti, kapda, makan, their basic shelter necessities. As you grow up the income ladder, right, you tend to discretionary consumption, that which you choose to buy. So those are higher value products, longer held products, and so that consumption industry will get a strong boost from one. Two is, if you look at the relative comparison with China, right? China was buying 6 million cars in 2006 when they were at same per capita as India. They went from 6 million to 30 million.
Yeah.
India is today at 3 million.
But it's stalled, right? It's just stalled. The Indian car story seems to have kind of taken a bit of a stall right now.
That's only because you have the BS6, you have the financing crisis, but when you look at a decade, these are all things, they all will pass. I don't think that's something which is going to sustain for a very long period of time. So that's one. The second thing which is happening very fundamentally is the fact that interest rates are trending down, right? Loan tenors are going up. So you see the affordability factor is changing hugely. Another factor which is changing is the urbanization of India. You see the proportion of India living in the top cities versus this, and you have a lot of urbanization now, smart cities and all converting. So a person who's sitting in rural India wears a shirt and a dhoti, a guy comes here wears a jeans. So automatically the quantity and the quality of his expenditure changes. Then there's the breakup of the joint family system. So there's a whole bunch of factors which are converging together. Again, I said you need to have a perspective of a decade, because this is going to happen in 2022 or 2024, I don't know. But I know that it's definitely going to happen by 2027 to 30. So if you take that perspective and say, okay, this money I will set aside for 10 years and not look at it, right? I'm saying that's the money which is going to deliver the best return for you and not get swayed by what's happening in the course of this journey.
Okay, so I have a two-part question for you now. Part one is from a perspective of somebody who's got, or let's say, I'm putting you on the hot seat, Mr. Subramaniam. Let's say you get, I'm just making up these numbers, but let's say that you get 1 lakh rupees as a one-time bonus in the month of March 31st, and your monthly salary, let's say, is 50,000 rupees, right? And whatever your expenses may be. How do you deploy that lump sum right now within funds? What categories would you choose looking at the long term? And what kind of SIPs would you start looking at the long term again from that 50,000 rupees?
So I think that the right allocation from a cap curve perspective would be 65% large cap and 35% mid and small. Within mid and small, maybe 25 and 10. 25 mid, 10 small at this point in time for the customer from a multi-cap allocation of his capital, the capital perspective. The reason I say this is that the rest of the portion of his capital, I would put it in a multi-cap fund.
So
I would say that if you take your capital, let's say 30, 20, 10, half of your capital, you put it into 30% in large cap, 20% in mid cap, 10% in small cap.
That's about 60%.
Half. 30 plus 20, 50, sorry, roughly 60. The balance 40 you put in a multi-cap fund.
But all equity linked funds.
All equity linked fund. Because over 10 years, if you want to deliver value, it has got to be equity.
Okay.
Your fixed income is essentially something which will be trying to give you an FD plus return, but this is something which is going to give you possibly double the rate of inflation.
Okay, you would be doing that right now. This is how you would presume a lump sum money should be invested in.
Yes, yes.
Okay.
So you allocate 60% into the 3 cap curves in the way I said, and the balance 40 you hand it over to multi-cap fund manager. And the reason I say this is, while you do this, once a year, you look at it what your multi-cap fund manager's portfolio has done. And then you reallocate your half to the way that. So that way you're getting the benefit of the expert advice into your portfolio. You start this way, and if your multi-cap is following the same pattern, right now you give him the chance. 1 year later, you look at it and say, what is he doing? How much is in large cap, mid cap? The data is available in the fact sheets. Then you reallocate the 60% of your active allocation according to the multi-cap. So that way, it's a guided journey to the thing where you're not losing out on both the worlds.
Okay. And
the SIP part, I would reverse the ratio in terms of mid and small cap and large cap, because mid and small caps tend to be more volatile. But since I see this whole thing ending on a high, right? SIPs will always do better for you when there is intermittent volatility in the middle, but the end is higher than the beginning. So these are the two. When SIPs don't do well is when it is a very stable market, but at the end is lower than the. So if you just flip that side, I see that the end is going to be very good. And I see that there's going to be lots of volatility in the journey. So in an SIP, I would actually say that you put 60% of your portfolio into small and mid caps and only 40% into large caps.
Okay. What are the risks to this growth assumptions? You mentioned at the start that you've been conservative when you've looked at these numbers. And viewers also remember that when we're talking about the 10-year return, the assumptions put in place, whatever the 15% average or 4x wealth creation, some funds might actually do better than that also, and some funds might not do as well as that also. You've got to keep that at the back of your mind. But Mr. Subramaniam, what are the risks to these assumptions? So
the risks are 2-3 things.
Mutual fund invest in risks.
Mutual inherent risks are, one is that when you set this 2030 as a decade, this 4x might happen in 2031 or 2029. Correct? So when you set this as a goal, I would say you decide, okay, are you reasonably bullish on this, and say, is 4x what you want? When you hit 4x, exit. So it may do it in 2028. You shouldn't say, oh no, Mr. Sunil said 2030 is the El Dorado year, so I wait or no. Because markets tend to be lead indicators, they tend to, so if you have got that goal, I've given you a guidance saying 4x multiplier of a capital is a very good return to aim at. If you make that a bit earlier, then you exit at that time.
Okay.
That's one risk, because that's the risk with mutual fund, because this is the timing wise. Second is that from a risk of the mutual fund is that if you're given 10 years to any fund manager, generally he will deliver. So it's not about fund manager selection so much. But I would say that in an earlier show we talked about rolling returns, right? So I would encourage you all to look at the rolling returns track record of various fund managers and see in a 10-year period, which is the fund manager who has the better average return and the least minimum and the maximum, so that his 10-year track record helps you to find the new 10-year. Because fund manager, right, that's one thing. The other thing is that try and choose some place where the fund manager has been there for 10 years, because the likelihood that he'll be there for the next 10 years, then you're buying the fund manager himself and not just somebody changes course in the middle, he may change his way, his thought processes. So mutual fund risks are essentially these things, that the consistency of the thought process pays dividend in the long run. But that person must be in the job for that consistency to pay off. So you can generally take a call saying this guy stayed 10 years, he's now unlikely to shift. I'm saying these are all the risks. The other risk here would be that as manufacturing goes up, right, and consumption takes advantage over savings, money into mutual funds, the sustainability of the flows into mutual funds over a decade, and I would actually say that if people are going to get consuming more, then it's the cost of savings. So part of the reason mutual fund deliver returns is people have been giving more and more money to mutual funds. So that's over a 10-year period. That's something which has a demographic trend on how people save versus consume, we have to observe and see. So that's another, I'm just pointing out the risk factors from a longer term perspective. And finally, I would say that from the economy perspective, still the risk factor comes from the fact that If the government does not succeed in providing these jobs, then we are looking at a very, very different scenario in the country, right? So obviously the basic thing is, and a risk to this whole perspective to this is, there is this force of automation, which is actually trying to reduce the number of people working. And we are entering into the phase when automation is picking up and India has surplus labor. So what India has to do is to make automation less competitive. Right? So that's why I took per capita income only of 5,000 in 10 years. Reason is that we can't replicate that China story, because today there's a pressure of automation so the labor cost will not jump up as much as China's jumped up, because you have to take lesser wages if you want to compete with that machine at the other end. So this again is a risk factor to the whole thing.
Okay, interesting. Well, let's wrap this conversation with one question, Mr. Subramaniam. You have an NFO open, if I'm not wrong.
That's right.
Can you quickly tell us what is this fund about? What's the rationale for launching this fund at the current point of time?
Yeah, okay. So this fund is called a Balanced Advantage Fund. So it's actually a dynamic asset allocation fund. What it does, it takes the money, it puts it across equities, fixed income on the other end, and there's this class called arbitrage, which actually is hedged equities, right? So, and then the other beauty of this fund is that within the equity allocation, it does mid cap, small cap, and large cap. So the dynamism of this fund means that what it is trying to do is that broadly give you an equity oriented fund. So if we are negative on equity, which is generally judged by the P ratio of the market, if valuations are too high, we reduce the equity component, but we try to maintain the taxation of 65% by using hedged equities as a component. So hedged equities have this advantage, they give you fixed income like returns, but equity taxation. So using that, we can actually run a portfolio which is 1/3 risk, 2/3 safety, or at the same time give you equity taxation. So the idea behind this fund is that in the journey ahead, India's recovery story is good, but markets being lead indicators prices tend to rise ahead of the actual earnings coming through. So there are periods in the market when valuation seems very, very high, and then there are periods when the reverse happens, in a typical cyclical story. So what this fund is trying to do is, while keeping the focus on equities as the asset class is going to deliver long-term wealth creation, is trying to manage the emotional journey of the customer, that when valuations are high and he looks at his portfolio, it wouldn't be taking so much risk. So it's a thing where I would say that the journey to the pot of gold at the end of the rainbow, where the journey is also being managed, because customers have an emotional aspect to their investing apart from the end goal. So I think the balanced advantage category essentially is to cater to keeping the customer happy in the journey to wealth creation. And today's time is an ideal time, because as we are seeing, right, in the last 6 months, small cap, mid cap have rallied. The earnings have not yet come, but the market is in a way betting on the future. So you are in that kind of a state where the market is saying future looks good, but when the future actually is going to turn good, until then you're going to have this little bit of a thought process. So this fund helps to manage that. That's why it comes into the hybrid category, which is a little bit of this and a little bit of that. So
okay. Well, all the best with that. And thanks so much for giving us this perspective, Mr. Subramaniam. Hope people do create that kind of wealth and more over the course of the next 10 years.
Right.
Appreciate your time.
All the best to your investors.
Thank you. And viewers, thanks for tuning into this leg of the Mutual Fund Show.